For most of human history, money didn't exist, and barter ruled, trapping every deal in a web of friction and chance. A king in ancient Lydia changed everything with stamped coins, igniting a chain reaction from gold to paper, trust to control, until today's invisible digital cash. The evolution of money, how we got here, is the story of how every revolution in currency upended society, leaving us safer, richer, but more exposed than ever. Now, as money detaches from anything physical, the next chapter is unwritten. Could the future of value be decided by code instead of kings? A farmer stands in a crowded market, clutching a sack of grain. He scans the stalls, searching for a potter willing to trade bowls for food. But the potter shakes his head. He needs wool, not wheat. The farmer moves on, his grain growing heavier with each step. In the world of barter, every exchange demands a rare alignment of needs, a double coincidence. The potter must want grain at the same moment the farmer wants pots. If not, the deal collapses. Days pass, and the farmer's grain risks spoiling. The potter's shelves gather dust, waiting for someone who needs clay and has something he desires in return. Anthropologists have traced these tangled negotiations across early societies, from the river valleys of Mesopotamia to the villages of ancient China. Goods like salt, cattle, or even shells sometimes step in as makeshift currency, but each comes with its own problems. Salt dissolves in the rain. Cattle can't be divided without loss. Shells are beautiful, but too common in some places, too rare in others. The friction of barter slows everything down. Trade is limited to what can be carried, what won't rot, and what someone else happens to want. Trust becomes fragile as value shifts from person to person, day to day. Markets shrink to the size of coincidence. For the farmer and the potter, and for countless others, the search begins for something better, something durable, portable, and universally desired. The world is ready for a new kind of exchange, one that can outlast the seasons and bridge the gap between strangers. On the western edge of ancient Anatolia, King Alyattes of Lydia faced a world hungry for order in trade. His kingdom, rich with electrum from the Pactolus River, held a secret locked in the pebbles, an alloy of gold and silver, rare and bright, but difficult to judge by eye. Alyattes ordered these precious lumps melted, weighed, and struck with an official seal. Each stater bore the king's mark, a roaring lion pressed deep into the metal. For the first time, value was guaranteed not by reputation or barter, but by the authority of the state and the certainty of the stamp. Merchants, soldiers, and tax collectors could now carry their wealth in a pouch, confident that every coin would be accepted far from home. The Lydian stater, averaging 14 grams, set a standard for honesty in trade. Counterfeiting or clipping was a direct challenge to royal power, and mint officials enforced purity through careful assaying and touchstone tests. Under Alyattes' son, Croesus, the system advanced further. Gold and silver coins were minted separately, each with their own fixed weight. The world's first bimetallic currency made it possible to price goods precisely and pay debts across borders. The idea traveled quickly. Greek cities along the coast adopted stamped coins, adapting designs to their own gods and rulers. By the 3rd century BCE, Rome entered the story with the denarius, a silver coin weighing about 4 grams, struck in the official mint. Roman law required every denarius to meet strict standards, and the state's guarantee fueled confidence from the markets of Spain to the bazaars of Egypt. Stamped metal money transformed trust. No longer bound to the quirks of barter or the perishability of goods, value became portable, divisible, and, above all, reliable. Each coin carried a silent promise. The power behind the stamp would stand behind its worth. In the crowded markets of Song Dynasty China, merchants once carried heavy strings of coins. But by the 11th century, a new tool spread through their hands: paper notes, crisp and stamped with official seals. These notes promised that, at any time, the bearer could exchange them for a fixed amount of precious metal. The promise was simple, but powerful. Paper could stand in for silver, as long as the trust held. Centuries later, European bankers and governments borrowed the idea, issuing their own notes, each one backed by a vault of gold or silver. By the 19th century, the gold standard became the rule among major economies. A British pound, a French franc, an American dollar, all could be traded for a set weight of gold. This discipline anchored currencies to something tangible and rare, but it also tied the hands of governments. When crisis struck or war erupted, the supply of money could not expand without more gold. In July 1944, delegates from 44 nations gathered at Bretton Woods, New Hampshire. They argued late into the night, searching for a system that would balance stability and growth. John Maynard Keynes, representing Britain, favored a new international currency, Bancor, while the Americans, led by Harry Dexter White, insisted on the dollar's central role. The final agreement pegged world currencies to the dollar, and the dollar itself to gold at $35 an ounce. The International Monetary Fund and World Bank were born out of these debates, their charters signed in ink still fresh from the conference tables. But as decades passed, the world's appetite for dollars outgrew America's gold reserves. On August 15, 1971, President Richard Nixon appeared on television to announce a sudden break. The United States would no longer exchange dollars for gold. The promise behind every note now rested not on metal, but on faith in the government. Money became fiat, a creation of law and policy, not physical scarcity. The gold anchor was gone. What replaced it was flexibility, but also uncertainty, as the world entered a new era where value was set by trust alone. In 1694, a group of London merchants and government officials gathered to solve a problem that threatened the entire English economy. Wars had drained the royal treasury, and the old system of borrowing and coinage could no longer keep pace with the demands of trade and conflict. Their answer was the Bank of England, a new kind of institution designed not just to store gold, but to manage and multiply it. The bank accepted deposits and issued notes, promising to pay the bearer in coin. But behind the scenes, it kept only a fraction of that gold on hand. The rest was lent out, fueling commerce and government spending. This practice, known as fractional reserve banking, allowed money to stretch further than the metal in the vaults. With each loan, the bank created new credit, money that did not exist before. This power came with risk. If too many depositors demanded their gold at once, the system could collapse. Early central bankers became guardians of trust, balancing the needs of growth with the dangers of panic. Their toolkit grew over time, setting minimum reserve requirements to limit overlending, adjusting interest rates to cool or heat the economy, and later, buying and selling government bonds to guide the flow of money. As the model spread, first to Scotland, then to France, and across the Atlantic to the United States, central banks became the quiet architects of stability. Their policies shaped the fate of currencies, businesses, and entire nations. The promise behind each note or deposit was no longer gold alone, but the credibility and judgment of those who managed the system. In 1973, a group of bankers and technologists launched a quiet revolution from a small office in Brussels. Their creation, SWIFT, the Society for Worldwide Interbank Financial Telecommunication, wove a digital web across continents. For the first time, banks from Tokyo to Toronto could exchange secure payment instructions in seconds, not days. Each message carried codes, not cash, but the effect was real. Trillions of dollars could move with the push of a button. The SWIFT network soon became the backbone of global commerce, invisible to most, but essential to nearly every international transaction. This hidden infrastructure also became a lever of power. In 2012, the world watched as Iran's largest banks were cut off from SWIFT. The decision, driven by governments and enforced by the network, froze billions and sent shockwaves through oil markets. Sanctions no longer meant just freezing assets. They could mean erasing a country from the world's financial map. Bankers debated the risks behind closed doors, but the precedent was set. Payment rails could be used as tools of diplomacy or punishment. While banks built bridges across borders, another transformation was taking place in wallets and pockets. The 1960s and 70s saw the rise of plastic credit cards, Bank AmeriCard, later Visa, and its rival, MasterCard. Electronic authorization replaced handwritten slips, and credit scoring systems began to shape who could spend and how much. By the 1980s, millions swiped cards for groceries, flights, and gifts, trusting in invisible networks to settle the bill. The convenience came with new forms of risk, debt, data, and dependence on sprawling systems. But for many, the world of money was now just a signature or a magnetic stripe away. In the late 1990s, a few lines of code let people check their bank balances from home. At first, online banking was little more than a digital ledger, slow, clunky, and limited to viewing statements or scheduling bill payments. But as internet speeds grew and smartphones arrived, the pace of change accelerated. By the early 2010s, banks and tech startups began racing to make money move at the speed of a swipe. Contactless payment cards and mobile wallets like Apple Pay and Google Pay turned phones into digital purses. Near-field communication let commuters in London tap their way onto trains, while shoppers in Shanghai paid for coffee with a quick scan of a QR code. In India, a different experiment unfolded. The Unified Payments Interface, or UPI, launched in 2016, promised to connect every bank, every app, and every user in real time. Overnight, millions could send money instantly. No cash, no waiting, just a phone number or a virtual ID. During the 2016 demonetization, as old rupee notes vanished, UPI transactions exploded from thousands to millions per day. Street vendors, taxi drivers, and small shops joined the digital flow, drawn by speed and simplicity. But every leap forward came with a new dependency. Instant payments rely on networks, servers, and code, systems managed by banks, governments, or private companies. The faster money moves, the more it depends on unseen rails and central control. For the builders behind these systems, the challenge is not just speed, but trust. How to keep money moving for everyone, everywhere, without sacrificing security or freedom. On January 3, 2009, a new kind of money quietly came to life. The first block of Bitcoin's blockchain carried a message. The Times, January 3, 2009, Chancellor on brink of second bailout for banks. Satoshi Nakamoto, the pseudonymous creator, had written a manifesto in code. A decentralized currency, immune to central banks and political whims. Bitcoin's white paper, published in 2008, described a peer-to-peer system where anyone could join, verify, and transfer value without permission. The blockchain, a public, tamper-resistant ledger, recorded every transaction, sealed by cryptographic proof rather than institutional trust. As Bitcoin spread, the dream of open finance took hold. Developers built new platforms that went beyond digital cash. By 2017, protocols like Aave allowed strangers to lend and borrow without banks. Uniswap let users swap tokens instantly, guided by mathematical rules instead of brokers. This movement, known as decentralized finance or DeFi, promised to break down barriers, cut fees, and return control to individuals. Billions of dollars flowed through these experimental systems, each transaction visible to anyone, yet tied to no single authority. But the same openness that fueled innovation also opened the door to risk. In 2014, Mt. Gox, once the world's largest Bitcoin exchange, collapsed after hackers stole more than 650,000 coins. In 2016, a smart contract called the DAO raised $150 million in Ether for a decentralized venture fund, only to be drained by an attacker exploiting a coding flaw. The Ethereum community split over how to respond, with one group choosing to rewrite history and another insisting the code must stand. In 2022, the Terra ecosystem unraveled in days. An algorithmic stablecoin, designed to hold its value through code alone, lost its peg and triggered a $40 billion wipeout, sending shockwaves through the wider crypto markets. Each failure exposed the limits of code and consensus. Governance disputes, design flaws, and the absence of safety nets left users vulnerable to loss. For every headline about freedom from banks, another followed about vanished savings or frozen assets. The promise of decentralized money, borderless, permissionless, resilient, now stood in tension with the realities of complexity, volatility, and trust. As governments watched these experiments unfold, questions mounted about who should control the future of money and what new risks society was willing to accept. In government offices from Beijing to Nassau, new teams of engineers and policymakers began drafting blueprints for the next phase of money. Unlike cryptocurrencies, which operate outside official oversight, these projects would be built and managed by central banks themselves. In China, the ECNY pilot started in 2014 with a simple question: could digital cash combine the speed of mobile payments with the authority of state money? By 2020, the People's Bank of China was distributing ECNY to millions of citizens, testing its use in everything from transit fares to festival giveaways. Internal debates unfolded behind closed doors. Engineers pushed for layers of privacy to mimic the anonymity of cash, while officials insisted on traceability to fight crime and enforce policy. The result was a compromise. Small transactions could pass with minimal data, but larger sums triggered full identification and reporting. Thousands of kilometers away, the Bahamas launched the sand dollar in 2020. Here, the challenge was different. Many islanders lived far from bank branches, relying on cash that could be lost in storms or stolen. The sand dollar promised instant, secure payments, even offline, when hurricanes knocked out power or cell towers. Local business owners signed up, and the central bank tracked adoption, adjusting features to fit daily life. In Nigeria, the Naira began rolling out in 2021, aiming to boost digital access for millions without bank accounts. Early reports showed mixed results. Some citizens welcomed the convenience, while others hesitated, wary of state monitoring or technical glitches. Design choices shaped every pilot. Some systems worked like traditional bank accounts, tied to a name and number. Others experimented with token-based models, letting users hold digital cash directly on their phones or smart cards. Privacy, programmability, and offline capability became points of tension, with each decision weighing inclusion against control. Central banks published findings, debated trade-offs, and watched one another closely. The old question, who controls the rails, now played out in code, policy, and public trust, with no final answer in sight. In 1971, the United States ended the direct convertibility of the dollar to gold, marking the definitive shift to global fiat currency. This documentary has traced how money evolved from barter's double coincidence problem, through Lydia's stamped coins and Song Dynasty paper, to the digital rails and cryptocurrencies of today. Across centuries, each transformation was driven by the need for trust, stability, and scale. While the introduction of central banking and networks like SWIFT centralized control, the rise of Bitcoin in 2009 and central bank digital currencies has reopened debates about who holds monetary power. Key questions remain unsettled, such as how digital currencies might impact privacy, or whether cash will truly disappear. As of 2024, more than 130 countries are researching or piloting state-backed digital currencies, according to the Atlantic Council. The story of money is unfinished, shaped by technology, policy, and public trust. Its next chapter will depend not just on innovation, but on decisions yet to be made.